Silver is going to $300 an ounce. The banks have lost control of the precious metals market, and the biggest physical short squeeze in history is now underway. That is the latest warning from Eric Sprott, one of the most successful resource investors alive, in his latest interview. If you do not know who Sprott is, you need to. He's a billionaire investor and the founder of Sprott Inc., one of the largest precious metals investment firms in the world. He bought his first gold and silver in the year 2000 and has been deploying capital into the mining sector for 25 years. He is the single largest shareholder in Hycroft Mining, which holds over 2.6 billion silver equivalent ounces. He is currently the most active dealmaker in the junior mining space, having deployed tens of millions of dollars into silver companies in the last few months alone. When Eric Sprott moves capital, the entire resource sector watches. In this interview, he warns that the physical silver market is draining, that the banks that shorted 500 million ounces on COMEX are now being forced to deliver into a rising market, that India just opened the floodgates for $100 billion in potential gold and silver buying, and that mining stocks are about to see the kind of multiple expansion that only happens once in a generation. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you are getting value from the videos, hit that subscribe button. It is free, it supports the channel, and you can always change your mind later. Now, here is exactly what he said.
There's no doubt there's a physical short squeeze going on. Yeah. We can track the inventories at the LBMA, we track them on the CME. We can track them on the Shanghai Gold Exchange. So, for example, Shanghai today, they lost 10% of their inventories today. They're down to about 11 million ounces. I mean, that's almost zero for a country the size of China. So everywhere you look, you see issues. There's some shenanigans going on that are trying to get the banks off their short positions, because there's still a short position of, I think, roughly 500 million ounces of silver on COMEX. And I don't see the miners doing that. It's mostly banks. In fact, there was a delivery report today for the March contract, and the second largest person issuing physical silver was the Bank of Nova Scotia. And they delivered about 5 million ounces. You know, if you're short 5 million ounces and it was coming up on February 26th. Isn't it wonderful that the silver price went from 120 down to 80? Mm-hmm. Think of the saving on 5 million ounces. I mean, you're talking a couple $100 million here. So that's serious stuff. It's all these banks that thought they could control gold and silver, that they've lost control of gold. And I'm pretty certain they've lost control of silver here. I've always thought that we should go back to 15 to 1. Yeah. And our way in going to 15 to 1, we'll overshoot. So we might go to 10 to 1. And as you pointed out, the mining ratio is 8 to 1. The utilization of silver versus gold, maybe 10% of gold is utilized somewhere and 90% is just stuck in a vault. Whereas in the case of silver, I'm sure that 100% of all the mined output is used every year, in whether solar panels or solid state batteries or you name it, healthcare, whatever, it's used. So it's a more useful commodity. Therefore, it might, in some sense, be more valuable than gold. And I do my own work. Like, I've always believed in 15 to 1. Well, 15 to 1 says $300, right? So if somebody's saying 150, I can get it. And I can still think maybe 300. And you're not paying for it. To think that you can buy it for, 5% of what its value would be at 300. You pay 5%. Wow. You're going to make 20 times on your money. That's a pretty good deal. You can't get that anywhere else.
So there is Eric Sprott, a billionaire who has been in this market for 25 years, telling you that the banks have lost control of the precious metals market, that there are 500 million ounces of silver shorted on COMEX with no way to cover, and that silver is heading for $300 an ounce based on the 15 to 1 ratio with gold at $5,000. Let's put those numbers in context. Silver is currently above $75. At a 15-to-1 ratio with gold at $5,000, that is $333. At a 10-to-1 overshoot, which Sprott says is likely, that is $500. Even his conservative anchor of $150 represents a double from current levels. And he is saying you can buy mining companies at 5% of what their value would be at those levels. That is 20 times your money. The physical market data confirms the squeeze he is describing. Shanghai Gold Exchange inventories dropped 10% in a single day. COMEX registered silver inventories have been declining for months. The LBMA is under sustained pressure, and the Bank of Nova Scotia just had to deliver 5 million physical ounces against its short position. When banks that have been short for years are suddenly forced to deliver physical metal into a rising market, that is the definition of a short squeeze. On the demand side, something massive just happened that most investors have not processed yet. India's securities regulator SEBI just announced that mutual funds and ETFs in India can now allocate up to 35% of their assets into gold and silver. The pool of assets affected is $385 billion. That means over $100 billion in potential new buying. And India said they will not price off the LBMA or COMEX. They will use prices established in India. The Eastern world is taking over the pricing mechanism from the Western exchanges. On the broader macro side, the conditions that drive precious metals are all in place. The S&P 500 is down 4% on the year. All three indices have broken below their 200-day moving averages. Goldman Sachs data shows systematic trend-following funds have turned US equity exposure negative, with some quantitative managers cutting their equity allocations to absolute zero and rotating into gold and treasuries. Moody's puts recession odds at nearly 49%. The national debt has crossed $39 trillion. And Professor Steve Hanke has published research showing $136 trillion in total US government liabilities. Gold is above $5,000 and silver is in the low 90s as of this recording. The super cycle that multiple analysts have been warning about is now visible in the data, and Sprott is deploying capital at a pace that suggests he believes the biggest move is still ahead. Now, he explains why India changes everything, why the mining stocks have 100% upside just to catch up with the metals, and why the institutional money has not even arrived yet.
The Indian government came out and said, we're going to mandate that mutual funds and ETFs in India can now own up to 35% of their assets in gold and silver. And this pool of assets is $385 billion. That's a little over $100 billion. And of course, the biggest owners of gold and silver in the world are the Indians. And then they made one other important comment. We are not going to price off of the LBMA or the COMEX. We don't want to, we're going to use prices established in India. We're going to get into what I call the Nortel effect. And the Nortel effect is when the world decides they want to own something. So all these funds from around the world would buy Nortel. The weighting in the TSX would just keep skyrocketing, and none of the Canadian institutions could then thereby have enough. Well, that's what's going to happen in the gold stocks. As everybody wants to buy gold stocks, and they're predominantly listed here, or the Canadian domiciled, there's going to be a shortage impact here. And the stocks have massively underperformed the price of gold and silver. There's a lot of catching up to do. I bet you there's 100% catch up to do without the price of silver or gold even going up. I have not seen it. I wish I could say that. I mean, I actually do ask the question very often when I'm involved in underwriting. Are there any non-gold funds that are participating?
Yeah.
And so far, it's been pretty de minimis. You know, I don't think that it's hit yet. And of course, I always sort of jokingly say, well, you know, maybe the pension fund managers won't figure it out, but the computers will. When they say, oh, the best performing group this month, oh, that was gold. Yeah. Best performing group the next month, gold. Next month. Best group for the year, gold. Well, when are you going to put it together? The world's buying gold. And I'm going to credit a guy named Don Durrett. He says, look, silver's going to 150. What is this going to be worth at 150? And of course, the number is always like 10 times higher than where it is. And I believe that. I mean, I believe it will be 150. I wouldn't even rule out it's going to be way beyond 150 because of all the things that are going on. Imagine if India actually starts buying this stuff. It'll be crazy. You put 150 on some guy producing a million ounces, all of a sudden he's making $150 million of profit. And you put a multiple on that now. And the upside is just, it's magnificent. There's many, many companies that could go up 10, 15, 20, 40 times with the endowment that they have with price increases. I heard about a manager in England who ran $1 billion fund. He just received another billion. And I think, okay, bring it on. Like the billion, you try to put $1 billion into some of these stocks, particularly the junior or intermediate size guys. I mean, there's going to be some serious run up going on here.
So there is Sprott explaining why the institutional wave has not even started yet. No pension funds in the underwritings, no non-gold funds participating, and a $1 billion fund manager in England just received another $1 billion to deploy. When that kind of capital starts flowing into a sector where the average company has a market cap of $50 to $200 million, the maths become explosive. And the Nortel effect he describes is a structural phenomenon that most investors have never thought about. Gold and silver mining stocks are overwhelmingly listed on the TSX and TSX Venture in Canada. When global capital decides it wants exposure to this sector, there is a finite number of shares to buy. The weighting in the index starts rising. Canadian institutions are forced to increase their allocations just to stay benchmark neutral. Foreign capital piles on top of that, and the share prices gap higher in a way that has nothing to do with the underlying metal price. It becomes a supply and demand imbalance in the equities themselves. This is happening against a backdrop of historic macro stress. The S&P 500 is down 4% on the year. Goldman Sachs shows quant funds cutting equity allocations to zero. Moody's puts US recession odds at nearly 49%. Commercial real estate defaults are at all-time highs with a CMBS delinquency rate of 12.34%. Private credit is freezing up with Apollo and Ares capping withdrawals. The national debt is at $39 trillion with $136 trillion in total liabilities. And the bond market is rejecting US treasuries during a war. On the oil shock, Brent crude has spiked above $112. The dated Brent price hit $144, the highest ever recorded. Gas is above $4.16 nationally. The IEA has warned this crisis could be worse than the 1970s, and Rick Rule, another veteran resource investor who runs his own bank, is building cash specifically to prepare for what he believes could be a 2008-style liquidity crisis. Meanwhile, Sprott is doing the opposite. He's deploying aggressively. $3 million into Rio Silver, $10 million into Silver Company, $40 million into Highlander Silver. He owns over 40% of Hycroft Mining with its 2.6 billion silver equivalent ounces. He has 168 mining stocks in his portfolio, and he is still buying. The divergence between the smartest resource money deploying at maximum speed and the broader market ignoring the sector entirely is as wide as it has ever been. And Sprott says the catch-up alone, without the metals even going higher, is 100%. Here is where he puts it all together and explains what happens when the physical market finally overwhelms the paper market.
Yeah. We're already seeing it. I mean, we saw a pretty good decline yesterday in NASDAQ. Gold stocks start rallying at 11 o'clock in the morning as they're beating up on NVIDIA. You know, you can see the sea change happening here where gold stocks go up sometimes when the price of gold goes down. That's never happened. And I think it's the people who had control of markets don't have control of them anymore. So the market can find its own proper positioning. I'm thinking that the seniors are proving they don't understand metal markets. They might understand mining, but it's not the mining that's important. Most of these guys, their production never goes up anyway. Barrick goes down almost every year. Newmont goes down almost every year. So how are you going to cut it? Well, you maybe should get your price forecast right and go and buy something while it's cheap. Could have bought the whole thing for $100 million 8 months ago. 100 million. It's gone up by 40 times. 40 already. Why wouldn't you do that? It's in Nevada. It's got a lot of infrastructure. Had a nice resource. You know, when I think back to Kirkland Lake, once we had control of Fosterville, I could see what the earnings were going to be. And I thought, why is this stock not going up? And hardly anybody ever bought it until they finally ran out a good quarter with Fosterville's production in it. And it went right from, 20 to $70. Don Durrett says, well, this is going to be a 30 bagger. It's going to be a 20 bagger. Well, wouldn't you like one of those things?
Yeah.
Like, come on, 20, 30 bagger. Can you get that one through your mind? Like, where do you get opportunities like this? Nowhere else. The only place you get a deal like that. It's a metal where the price has exploded, where it looks like it can sustain itself.
So there is Eric Sprott laying out the full picture, and his message is unambiguous. Silver is going to $300. The banks have lost control. The physical squeeze is underway. India just opened the door to over $100 billion in new buying. Institutions have not arrived, and the mining stocks have 100% upside just to catch up with where the metals already are. This is a billionaire who has been in this market for 25 years. He is not guessing. He is deploying tens of millions into junior silver companies in the last few months alone. Over 40% ownership in a company with 2.6 billion silver equivalent ounces, 168 individual mining stocks in his portfolio, and he is still buying. The physical data is confirming the squeeze. Shanghai inventories dropping 10% in a single day. COMEX shorts at 500 million ounces with no way to cover. Banks that were short being forced to deliver physical metal into a rising market. India rejecting Western pricing and establishing their own. $1 billion fund manager in London just receiving another billion specifically for the metal space. And the broader macro backdrop makes the case even stronger. The S&P 500 cracking. Quant funds going to zero equity allocation, recession odds approaching a coin flip, commercial real estate defaults at record highs, a $39 trillion national debt with $136 trillion in total liabilities, the bond market rejecting treasuries, oil at record physical delivery prices, and every single recession indicator flashing red, gold above $5,000, silver pushing into the 90s, mining stocks with 100% catch up before any further metal price appreciation, junior miners trading at 5% of what they would be worth at $300 silver, and the smartest money in the resource sector deploying at maximum speed while the rest of the market looks the other way. The question is no longer whether this bull market is real. The question is whether you are positioned before the institutions arrive and the catch-up begins. Stay informed, stay prepared, and make sure you are subscribed because we are tracking every development as this unfolds.